Okay, Assalamualaikum warahmatullahi wabarakatuh. Okay, today our topic is financial analysis. Okay, what we will cover for this topic, this is the learning outcome for this topic. The first one is explain on components and uses of financial statements. Okay, components and uses of the financial statement. Components and uses of the financial statement. The second one is explain the importance and types of the financial ratio. Importance and types of financial ratio. The third one, calculate the financial ratio itself, okay, based on the information in the financial statement. The fourth one, the last one, analyze the financial performance. We have to analyze the financial performance, either good or poor performance, based on ratios that we have calculated. Okay, this is actually the components under or in the financial statement. Okay, the first one we have flow G, statement of comprehensive income. The second one we have soft P, statement of financial position. We have statement of changes in equity, and also we have statement changes in the statement of cash flow, and the last one, notes to the financial statement or notes to the accounts. Okay, we have two types of users of financial statement, internal and external user. This subtopic you already know in the financial statement, financial accounting 1 courses. Okay, this is just for review, okay, or refresh your knowledge before this. We have shareholders, management, creditors, and employees. All of these users need financial information. For shareholder, they want to know either they can get dividend. For management, they want to know the company performance, either good or poor performance, what action to be taken. Creditors, either they want to give our company credit term or not. Employees, they want to know the sustainability of the company. Either the company can give salary, continues to give salary and bonus. Okay. Next, investor, they want to know the return from the investor, from the investment, ROI. Government needs to know the flow sheet, the net profit, okay, to take the amount of tax, okay, taxation from the company. And consumer, and also stocks exchange. Okay, overview, financial analysis, okay, enable users to understand, okay, and the firm financial position and its performance. Okay, how to understand? We can use financial ratio. Okay, from these financial ratios, we can identify either firm financials, strength or weaknesses. Okay, this is the three types of ratio comparison. We have historical analysis, budget analysis, and competitive analysis. Okay, what is the historical analysis? For example, we have financial statement for 2019 on financial statement of 2020. Okay, we calculate the financial ratio for 2019, and also we calculate the financial ratio for 2020. And then we compare the ratio calculated. This is we call historical analysis. Okay, for budget analysis, okay, what is the budget analysis? We compare within the budgeted amount what we targeted and between the actual amount. Okay, so this is budget analysis. How about the competitive analysis? Okay, competitive analysis, okay, we compare the financial ratio for company A and company B. Okay, but the company A and also company B falls within same industry, di bawah satu industri yang sama. For example, under industrial product. Okay, for example, under finance. Okay, for example, under consumer product. Okay, so this is the three types of ratio comparison. Okay, what is the advantages of ratio analysis? The first one, useful in financial position analysis, useful in simplifying accounting figures, so that kita lebih easy to understand, easy to easy to interpret because the amount from the figure million we turn to in percentage. Okay, for example. Okay, and the third one, useful in assessing the operational efficiency. The fourth one, useful for forecasting purpose. And then next, useful for locating business weaknesses. And the last one is useful in comparison in performance. Okay, this is the group of ratio analysis. This is the group of ratio analysis. We have 5 groups of ratio analysis. Liquidity ratio. First one is liquidity ratio. The second one is leverage ratio. The third one is profitability ratio. The fourth one is efficiency ratio. And the fifth one, the last one is market value ratio. Okay. For our syllabus, we only cover for these 4 group of ratio. Liquidity, leverage ratio, profitability ratio, and efficiency ratios. Okay. For liquidity ratios, okay, what we want to calculate the liquidity ratio. Okay, why we have to calculate liquidity ratio, class? Okay, liquidity ratio, we actually want to measure the ability of company to pay its short-term obligation. We want to measure the ability of company to pay its short-term obligation. Okay. What is the short-term obligation? For example, is current liabilities. Okay. What is item under current liabilities? We have accounts payable, short-term loan, bank overdraft. Okay. So that's why we have to calculate liquidity ratio. Either this company or our company can or not pay our short-term obligations. Okay. We have 2 ratio actually. The first ratio is current ratio. The second one is asset test ratio. The net working capital is just calculation of the net working capital. Okay. So we move to the example on how to calculate each of ratio. Okay. You are given the statement of financial position. Okay. Now how to calculate net working capital? Net working capital, current asset. Okay, current asset divided by current liabilities. Okay, our current asset. Now, current asset, where is our current asset? So, inventory, account receivable, others receivable, and cash. Okay, total of this. When we total up, we have 350,000. Okay, 350,000. We have 350,000 minus current liabilities. Okay, this is the current liabilities, account payables and others payables. Okay, 100,000 plus 50,000, so equal to 150,000. Okay, 150,000, so 200,000. Okay, this is our net working capital. The second one is current ratio. Okay, how to calculate current ratio? Okay, this is the formula to calculate the current ratio. Current asset divided by current liabilities. Okay, current asset 350,000 divided by current liabilities 150,000. So what is our last answer? 2.33 times 2.33 times. Okay, 2.33 times. Okay, what means by this answer or this ratio? 2.33 times means that, okay, what is our formula? Current ratio, current asset divided by current liabilities. Okay, so now our answer is 2.33. Okay, for every, how to interpret? For every 1 ringgit Company A current liability, Company A have 2 ringgit 33 sen current asset. Okay, or in other words, okay, Company A have 2 ringgit 33 sen current asset to settle each ringgit their current liabilities. Okay, Company A ni dia ada RM2.33 current asset untuk settle setiap RM1 dia punya current liabilities. Tu maksud dia. Okay, that's for current ratio. How about acid test ratio or quick test ratio? Quick ratio. Okay, what is the formula? Current asset, acid means quick. Quick ratio means we only measure the quick asset. Okay, what is the quick asset? Okay, only cash, account receivable, and cash equivalents. Okay, so exclude here is inventory and prepayment. Prepayment ni kita masukkan inventory also. Okay, sebab bila kita hanya nak yang cepat saja, yang quick saja, yang acid, yang mudah cair. Okay, so we exclude inventory and prepayment. So current asset we have 353,000 minus inventory 200,000. Okay, divided by 150,000 for current liability. So our answer is 1 times. Okay, so our quick ratio, okay, quick asset divided by current liabilities, so equal to 1.0 over 1. Okay, what does this current or quick ratio means? Okay, for company A have RM1 quick asset to settle its current, for every RM1 dia current liabilities. Okay, so company A ada RM1 quick asset untuk cover, untuk bayar dia punya RM1, setiap RM1 dia punya current liability. This means by acid test ratio. Okay, so we calculate already for current ratio and acid test ratio. Okay, I repeat. Okay, why we have to calculate the liquidity ratio? To measure the ability of company to cover its short-term obligation. Okay, next, gearing ratio. Okay, what is the gearing ratio and what is the purpose we calculated the gearing ratio, or the other's name is debt management ratio. Okay, why we want to calculate the debt management ratio? Because we want to know the company company performance, okay, compared to equity and also compared to total asset. And also we want to know the company ability to pay their interest expenses. Okay, this is the purpose of we calculating the debt management ratio. So on the debt management ratio, we have 4 ratios. The first one is equity ratio, debt ratio, the second one, the third one is debt to equity ratio, the last one is time interest earned ratio. Okay, still use the same financial information data for SOFP. Okay, how to calculate equity ratio? So how to calculate equity ratio? Shareholder equity divided by total asset. Okay, shareholder equity, what is our shareholder equity value? So this is shareholder equity value 200,000 divided by total asset 844,000. Okay, so 200,000 divide 840,000, so equal to times 100, equal to 23.81%. Okay, this is for equity ratio. Okay, what means by this ratio? For every RM100, okay, for every RM100, total asset, okay, they have equity or shareholder equity RM23.81. Okay, shareholder equity. Alright, for next one, the next ratio is debt ratio. Okay, how to calculate debt ratio? Debt ratio, total liabilities divided by total asset. Total liability divided by total asset. Okay, this is our total liability. Okay, the debenture, accounts payable and others payable. Okay, our total liability is actually 570,000. Okay, so 570,000 divided by total asset. For total asset 840,000. Okay, so the answer is 68%. Okay, 68%. 100 is total asset and 68 is total liability. Okay, how to interpret this ratio? That ratio, for every 100 ringgit total asset, this company have 68 ringgit total liability. So goods or not, okay, it's depend to the financial institution, okay, or for bank. Okay, either they want to give this company A, financing or not. Okay, either they want to give a loan or not for this company. Okay, normally financial institution will look at debt ratio. Normally below than 50% is considered good. Okay, but now is more than 50% is considered high debt. Okay, banyak hutang lah. Okay, so terpulang kepada company masing-masing, kepada financial institution masing-masing. Dia punya guideline masing-masing, sama ada dia nak bagi company tu pinjaman ataupun tidak. Okay, ada yang mungkin meletakkan 50%, ada yang letak 60%, ada mungkin yang letak 40%. So kalau dah exceed the certain percentage, dia takkan accept lah. Maksudnya dia takkan approve that loan. Alright, so this is debt ratio. Next, debt to equity ratio. What is the formula debt to equity ratio? Long term debt only divided by long term total equity. Okay, long term debt is a long term debt. Long term debt only debenture. 420,000 divided by equity. What is equity value? Equity, this is equity. Shareholder, share capital, retained earning and reserve. 270,000. Okay, this is equity. This is equity. Okay, so 420,000 divided by 270,000. So debt to equity ratio for company A 1.56 times. Okay, 1.56 times. Okay, how to interpret? So for every 100 ringgit, this company equity, okay, they have long term debt 1 ringgit 56 cent. It's considered high also. Okay, so the last one, time interest earned. Okay, why we have to calculate time interest earned? Why we have to calculate time interest earned? This ratio to measure our ability to pay interest expenses. Okay, mampu tak mampu bayar interest expenses ni. Okay, this is the formula, earning before interest and tax. Okay, the short form for this statement, or earning before interest and tax, we call EBIT. Okay, EBIT. It's not EBIT Liu, but EBIT. Alright. So, how to calculate EBIT? Or EBIT is already given for you. 84%, 84,000. So, 84,000 divided by interest expenses 12%. Okay, this is all for calculating time interest and TIE. Okay, time interest and. Okay, what is our answer here? Bahagi, we get 7 times. Okay, what means by 7 times? Okay, means by 7 times means that the ability of this company to pay their interest is 7 times from their total earning before interest and tax. Okay, dia boleh bayar sebanyak 7 kali ganda. Okay, dia boleh bayar 12,000 ni sebanyak 7 kali ganda lah. 7 kali pun boleh. daripada dia punya income yang sedia ada. Income dia adalah earning before interest and tax. Okay, earning tu adalah net profit ni sebelum interest dan cukai lah. Okay, so for time interest and higher is better lah. Okay, apa yang lower is better? Debt ratio tadi ni. Debt ratio lower is better. Debt to equity ratio pun sama. Lower is better. Okay, that's all for debt management ratio or gearing ratio. Okay, the function or the purpose why we have to calculate the debt management ratio, we want to know the debt position. Debt position from the total asset and from the total equity, and also the ability of the company to pay its interest expenses. Okay, now for profitability ratio, okay, why we want to calculate, why we want to analyze the profitability of the company, because we want to know either company is making profit or loss. Okay, so under profitability ratio, we have 4 ratio. The first one is gross profit margin. Okay, gross profit margin. The second one is net profit margin. The third one is return on asset, and the last one is return on equity. Okay, so let's look so how to calculate the gross profit margin. You are given the extract of the statement of comprehensive income, sebahagian daripada statement of comprehensive income. Okay, now how to calculate gross profit margin. Okay, gross profit margin, the formula of gross profit margin, gross profit divided by sales. Okay, gross profit divided by sales. Okay, where is our gross profit value? 200,000 divided by net sales 500,000. Okay, so 200,000 divided by 500,000 equal to, okay, 40% times 100, times 100, 40%. Okay, this is our gross profit margins. Okay, how to interpret this 40%? Okay, how to calculate the gross profit margin itself is net gross profit divided by net sales, right? Okay, now we get 40%. Okay, 40% means that for every 100 ringgit, sales, company A, they can generate 40 ringgit gross profit. Company A can generate 40 ringgit net as gross profit from 100 ringgit net sales. Okay, that's how to interpret gross profit margin. Okay, let's move to the net profit margin. Okay, net profit margin. How to calculate net profit margin? Net profit divided by net sales times 100. Okay, so net profit, our net profit 84,000 divided by net sales 500,000 times 100. So we get here 16.8%. Okay, so how to interpret this 16.8%? Okay, for net profit margin, net profit divided by net sales. So 16.8 per 100. Okay, for every 100 ringgit, company A net sale, they can generate 16.8 cent net profit. Okay, that's how to interpret. Okay, the third one, return on asset. Okay, how to calculate return on asset? Net profit divided by total asset. Net profit divided by total asset. Okay, our net profit is 84,000 and our net asset, still remember in the previous slide, okay, 840,000. 84,000. Okay, total asset. Okay, so 84,000 divided by 840,000. So the answer is 10%. How to measure? Same goes to net profit margin and gross profit margin. How to interpret? For every 100 ringgit company a total asset, they can generate 10 ringgit net profit. Okay, setiap 100 ringgit dia punya total asset, dia boleh generate 10 ringgit net profit. The last one is return on equity. How to calculate return on equity? Net profit divided by total equity. Okay, net profit 84,000. What is our total equity here? Total equity 270,000. Okay, so 84,000 divided by 270,000 equal to 31.11%. Okay, so how to interpret this ratio? For every 100 ringgit company A total equity, they can generate 31.1 ringgit net profit. Okay, so that's how to calculate and how to interpret the profitability ratio. Okay, I repeat again why we have to calculate the profitability ratio. You want to know either the company is making profit or not, or either the company is generate profit or generate gross profit from the sales and from the total asset and also total equity. Okay, next we move to the efficiency ratio. Okay, efficiency ratio or the other's name is asset management ratio. Okay, asset management ratio. Okay, asset management ratio. Okay, we have four formula here, four ratios here. The inventory turnover, day sales turnover, non-current asset turnover, and total asset turnover. Okay, so let's look at the example to calculate each of this ratio. The first one, based on the aforementioned information of company A, means that the previous information, and the total accumulated depreciation for non-current asset is 51,000, calculate inventory turnover. Okay, how to calculate inventory turnover? Sales divided by inventory. So our sales is 500,000. Okay, divided by inventory. Okay, where is our inventory value? Inventory value 200,000. Okay, so 500,000 divided by 200,000 equal to 2.5 times. Okay. Okay, what does this mean? 2.5 times times. Okay, 2.5 times means that the speed of inventory. The speed of inventory. Maksudnya kelajuan inventory tu to convert to the sales. Okay, how long our inventory can convert to sales? Okay, berapa lama kita punya inventory boleh bertukar kepada jualan? Okay, so sebanyak 2.5 kali. Okay, how to make an easier interpretation? We can convert this times, this 2.5 times into months for easier comparison. Okay, how to convert 12 months divide by 2.5 times. So then we get 12 divided by 2.5, 4.8 months. Okay, 4.8 months means that this company A, takes 4.8 months to convert its inventory to sales. Dia ambil masa 4.8 bulan in average. Okay, so how to make a decision or make a comparison between a company or between a historical performance. Okay, the shorter times for when we convert to the months, okay, the shorter times is better. But for before the converts to the months, okay, in times measurement, okay, the higher value is better or it's preferable. Okay, so that's for inventory turnover. Next, for day sale turnover or average collection period. Okay, why we have to calculate this ratio? We have to calculate this ratio because we want to know how long our receivables to pay their debts. Berapa lama kita punya penghutang ataupun account receivable boleh bayar dia punya hutang. Okay, so let's look the example. Okay, let's do the example. Receivable divided by sales times 365. Okay, receivable. Okay, what is our receivable value? Okay, here 100,000 divided by sales 500,000 here. Okay, and times 365. Days. So equal to 733 days. Okay, means that company A account receivable takes 73 days to pay their debt. Okay, dia ambil masa 73 hari untuk bayar dia punya hutang-hutang. So how to interpret and how to make a comparison? The shorter times is better. Okay, the shorter day sales turnover is better. Okay, takkanlah kita nak nak orang bayar hutang kita lama-lama kan? Okay, so that's why the shorter time is better. Okay, non-current asset turnover. How to calculate non-current asset turnover? Sales divided by non-current asset. Okay, our sales is 500,000. Net non-current asset. Our non-current asset only land, building and plant machinery 490,000. Okay, so 490,000. Okay, 500,000 divided by 490,000, and then we get 1.02 times. Okay, how to interpret this ratio? Is for 100, every 100 ringgit company A non-current asset, okay, they can generate sales 1 ringgit to sale. Setiap 100 ringgit dia punya non-current asset, dia boleh generate RM1 2 sen nilai jualan. So yang ini pula how to interpret, the higher is better lah when you want to make a comparison. Okay, because the higher rate will be give the higher sales. Okay, the last one, total asset turnover. How to calculate total asset turnover? Sales divided by total asset. Okay, sales, we have sale 500,000. Sales divided by 840,000. Okay, so our answer is 0.595 times. Okay, how to interpret this ratio? For every 100 ringgit, this company total asset, they can generate sales 59 ringgit 50 sen. Okay, for every 100 ringgit total asset, they can generate 59 ringgit 50 sen sales. Okay, so this ratio also the higher value or the higher turnover will give the higher performance, or the higher value is better lah. Okay, it's more preferable. Okay, so that's all for efficiency ratio and also profitability ratio. Alright. Okay, this is market value ratio. We want to calculate the earning per share and also price earning ratio and dividend yield. So it's not covered in your syllabus. Okay, but you can take the earning per share value is actually from the financial report. Okay, from the annual report, financial statement.